Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
On to our top story from the Bloomberg Terminal. The Biden administration has discussed capping sales of advanced semiconductors from companies like NVIDIA and other major chip firms on a country-specific basis. We are told the aim is to limit some nations' capabilities from gathering these sophisticated AI chips. Let's take a closer look now with Bloomberg's Annabelle Droulers, who joins us from Sydney. Annabelle, one of our tech reporters. Good of you to make time. I'm sure it's busy for you. Can you help me understand what we know so far about this?
Thanks, Doug. Yeah, I think we just need to look at sort of the broader context and the framework around this. So the US, or the Commerce Department in the US, has a framework called the Validated End User Program. That's the VEU program, rather, for short. Now, this is a mechanism that essentially allows the US government to track the transfer of export-controlled technologies to places like China and India. And last month, that was actually expanded to include data centers. Of course, AI data centers are a particular focus right now, and there's so much activity going around those. Now, the reporting today is looking at how the VEU framework could be used to restrict shipments of AI chips to places like the Middle East. The Middle East, we know it's a region that not only wants to invest more into AI cloud facilities, it also has really deep pockets to fund them. And so there's that concern perhaps around that growing relationship we see with the Middle East and China in particular, that the sort of export restrictions that are already in place to limit Beijing's technological ambitions in this area could be sort of circumvented through third-party countries.
So is this targeted at the countries or the companies? Because I think in our story we say that this could include asking companies, say in the Middle East, to reduce their ties with China.
That is sort of one of the ways that export licenses can be used as a point of leverage, because if you do want those chips, for instance, yes, the US can use the VEU program to say to a certain company in the Middle East, look, you can only have these chips if you're prepared to sort of cut ties in a way with China. It's a very difficult thing to enforce, though. And it's also that question of how would companies respond themselves, because we've already seen those export restrictions on companies like NVIDIA, for instance, and they also partially responded, yes, by limiting the most advanced technology, but they still redesigned certain chips to continue exporting to places like China as well.
Yeah, that's my question, is about, kind of transparency, tracking this, and enforcement. This has got to be very difficult to do.
Yeah, and that's certainly sort of one of the arguments, I guess, against it, because people would say that if you are going to continue to restrict China, then you're just simply as well going to still allow certain shipments of places to China. We've had reporting where you can still get that most advanced technology in places like Shenzhen, for instance. And at the same time, China continues to develop its own advanced chips in the background. And so that also becomes a concern as well. If you totally turn off the tap, then ultimately China still continues to progress, even if they're maybe a decade behind. They could catch up at a later point, and you've sort of had that dichotomy or duopoly that you've created in the system.
So I understand from our story that these deliberations are in the early stages, and there are talks underway, and almost everybody involved, the Bureau of Industry and Security, NVIDIA, AMD, other companies, Intel, they've all declined to comment. Is there some sort of catalyst that we might see where this kind of comes to the fore? Is this something that we may not hear much about for, say, a year?
No timing that we've had so far, really. I mean, what we understand from sources is the deliberations are in the early stages here. They could remain fluid. We have seen the US and the Middle East, or the UAE rather, putting out a joint statement on artificial intelligence. So they are at least talking about the use of AI technology, saying that there's tremendous potential for AI for good, and that there are the challenges and risks. But in terms of the timing for this or the potential catalyst, I really can't give any comment on that one in particular.
Yeah, it's interesting. I recall a Bloomberg article a couple of weeks ago talking about the possibility that maybe some countries in the Middle East could begin to host construction of some new chip foundries. Do we know any more about that?
That was some reporting, around TSMC in particular. And we know, of course, and actually last week I was talking with Taiwan's tech minister, that there are a number of countries that are, or regions as well, that are trying to win over the major tech companies to establish their bases there. We know the Middle East as well has got very deep pockets and they have very deep ambitions. They've been one of the real front runners in trying to grow AI technology. But TSMC, for its part, has denied that speculation. They came back and said that they didn't have any further investment plans into this region in particular. But certainly, of course, it's something to track.
It's been too long. Thanks for making time to chat with us. Annabelle Droulers there from our studios in Sydney. Annabelle is a Bloomberg tech reporter, normally based in Hong Kong, joining us here on Daybreak Asia.
Vanessa Chen, head of Asian fixed income in investment directing at Fidelity International, with us live in our studios. So we had this Caixin report talking about 6 trillion yuan. That's basically 2 trillion yuan, which we knew was coming in this next year, spread out over another 3 years. Some investors may turn up their nose a little bit to this, Vanessa, in that the feeling might be that the economy needs stimulus now, not 3 years down the road. But what are your thoughts on this?
I think the most important message that throughout the past couple of weeks from the Chinese government or the regulators is that the intention and the willingness to provide policy support, or if you call it stimulus, in order to continue the growth trajectory of the country. And I think that's probably is a fairly well planned and well orchestrated policy to have come through. We've seen the rate cuts that provide liquidity into market. And then there's also the capital market policies that's really trying to drive a little bit more wealth effect into the economy, and then subsequently focusing on the property sectors as well. And the MOF meeting over the weekend does help to address some of the kind of question marks in a lot of investors' mind related to local government fiscal health, as well as policies that will potentially help to recapitalize some of the large state-owned commercial banks as well.
So take us inside the fixed income markets in China right now. Help us understand the market response to a lot of these policies that have been rolled out. Is the market right now generally positive? What is it debating at the moment?
Yeah, I think, first of all, in China, there's a lot of wealth that's been locked into something called wealth management products. And a lot of this historically, maybe for the past couple of years, have been allocating to the China onshore bonds because of the liquidity, because of the high quality nature of it. And given the capital markets policy that's being provided, there's a lot of, if you would, unwinding of some of these wealth management products, which means that there's a little bit more pressure on some of the bonds at this juncture, where we see some of the corporate bonds spread widening, whilst there's a little bit more kind of flows moving into the equity market. And then on the other hand, some of the policy narratives that's provided by MOF, more on the potential additional debt quotas, potential special bonds issuances, or even ultra-long bond issuances, means that there potentially a little bit more supply coming through, and that also tilted a little bit in terms of the supply and demand balances when it comes to the bond market. However, if you look at slightly longer term, given the fact that Chinese government is likely to have a bit more easing policy when it comes to monetary side, we do think that the China onshore bonds continue to be offering value, particularly on the liquidity side as well.
So we understand that revved up fiscal spending is what investors and economists are most excited about now. It's kind of like the PBOC actions, cutting interest rates, and the RRR and such is way in the rear view mirror. So there's a lot riding on this, and some people have come on and said, well, we just have to be patient because we'll have the Standing Committee of the National People's Congress that will have to approve this. So you can't really confirm it now if you're the Ministry of Finance until it gets approved by the legislature. But in China, you know, when the party tells the NPC to jump, it jumps. So is this going to happen or not?
Yeah, I think which kind of come back to what I was the opening part of it, is the intention and the willingness, and coming out over the weekend to kind of I guess, reinforces some of the message that earlier on, late of September have been provided is important, is to give the market enough signaling that, yes, they're aware of the situation of the economy. They are on the path of willingness and continue the intention of providing additional support to the economy. I think there were some debate about whether there was a number and all that, but I think overall the policymaker probably wanted to retain a little bit more flexibility in the options as and when the economy is needed. There will certainly be policy support, particularly on the fiscal side, more targeted, more specific, in order to provide a little bit of a kick for the economy as well.
Vanessa, I'm curious, how are you observing the behavior of foreign investors right now, given everything that we're talking about? Is there appetite for foreign investors to become involved, or are they kind of at this point taking a step back and just waiting for a little bit more clarity, maybe some of the dust to settle?
Yeah, I think one of the it's a very interesting question because given my background as a fixed income specialist, we've been looking at the China onshore CGB market, China government bonds market, for a long time, and we've been sharing with a lot of investors that is a market where you can potentially get diversification benefits and low correlations compared to the Europe or US denominated asset class. And what we've seen is that for the past couple of months, there is a gradual pickup in terms of foreign investors' participation in the onshore CGB markets. Less so on the broader credit space, but probably more to capture some of the diversification benefits. So I would say on the fixed income side, there's gradually kind of coming back in terms of foreign investor participation in the market.
Vanessa, thanks so much for joining us here on Bloomberg Daybreak Asia. Vanessa Chen, Head of Asian Fixed Income Investment Directing at Fidelity International. Joining us now is Joy Yang, Head of Index Product Management and Marketing at MarketVector Indexes. Joy, thanks very much for coming on the program. We appreciate it. So here of late, in the past quarter, in the third quarter, we had breadth in the market, and that's something that we hadn't seen in a while. It had been pretty much all the Magnificent Seven and a clutch of other stocks. So I'm wondering, since those markets in the other four, or those stocks in the other 493, for a lot of the past year or two, they were kind of still in a bear market from 2022. So for them, this is like the beginning of something. This is the beginning of a bull market. Is that something that you think continues, or do you think this money will all rush back into the NVIDIAs of the world again?
Hi, Brian. Thanks. I think this is going to be an exciting week as we see third quarter earnings reporting. And as you said, we're finally beginning to see kind of this broader market lift across, outside of the big tech stocks. But yeah, we're nearing the end of the year. And I think it's because finally we're getting some kind of reprieve out of just focusing on inflation and labor data, and we're finally focusing back on fundamentals. And we're seeing this week, we're seeing the banks get lifted, so we're seeing some good earnings reports and expectations on earnings outside of just AI and technology. So I think that's going to be exciting. And we're seeing, the S&P as well as the Dow Jones Industrial hit all-time high. So I think that's, we're heading into another strong market quarter.
Yeah, S&P today, it's 46th record of the year at 58.59. Do we make it to $6,000 by the end of the year, do you think?
I mean, at this momentum, it's looking likely, but I think, there's still a lot of uncertainty in the market, especially with, we're now, watching the election. Geopolitical risks are picking up. So, what we're seeing is gold, which had also been trending up, along with markets, which is quite unusual, has now kind of flattened a little bit. I think people are being cautious. They're really waiting to see the next bit of news come out.
Yeah, that's a very good point, because not only is gold up near record highs, but you have the VIX at 20 when stocks are at an all-time high. That's a little unusual. I guess it just means that people are really hedged because they're long and they want to stay long. But there must be an interesting story behind that.
Yeah, exactly. And I think this is, it's quite unusual to see both go up at the same time when we're seeing that, these are two asset classes that should be, uncorrelated. But as you said, we're in unusual territory right now where we have this very strong market, but again, it had been narrowly led up till now, and people don't want to miss out. But at the same time, we're seeing all of these risks cropping up, whether it's around, global geopolitical tensions, trade wars, elections, even these, China markets resurfacing. And I think people are really trying to hedge the downside events and really trying to diversify to make sure they're positioned for, different outcomes.
Do you think there's the risk that we face fewer rate cuts from the Fed or less easing? Maybe that's another way of putting it.
I think it's really hard at this point because I think we saw last week, one data point, whereas previously we were seeing this small incremental trend back to, lower inflation and a control on the labor market. But, who knows what's going to show up in the next economic data? Was that a blip or is this, really an indication that, inflation is out of control, which will really surprise, I think, what people have been pricing in.
We just had a flash across the terminal that the U.S. government is weighing capping NVIDIA and AMD AI chip sales to some countries around the world. We don't have many details on this, but are U.S. regulators becoming China in the sense that there is almost this obsession with security now and, looking away from markets and from company and capitalism, which is U.S. is known for.
But what we're also seeing is this increasing escalation of trade wars. So we're seeing China with its overcapacity flooding the markets, and we're seeing not just U.S. markets, but markets around governments around the world trying to protect their local industries and really maintain some kind of competitiveness. So I think this is just, the progression of what we're seeing around protectionism and the escalating trade wars. So I don't, this isn't, unexpected. I don't know what other course of action, kind of these trade wars have placed governments into.
Joy, very quickly, 30 seconds or so. A big surprise for the Chinese markets, do you think, that we're seeing this kind of stimulus come in? Do you think we make new highs or at least see a meaningful recovery in Chinese equities?
It certainly was a big surprise based on market reactions. But I think what we saw, especially over the weekend, was the details are still forthcoming. So I think it's going to be, buy on the rumors, sell on the news, because, as, we see more and more detail, we'll see the repricing.
All right, Joy, thank you. Joy Young joining us here from MarketVector Indexes. Well, joining us now is David Asell, co-CIO at Mount Lucas Asset Management. David, back in August, we had a growth scare and markets got a little bit rattled. I'm curious, are we having another growth scare now, but one that is to the upside? Witness the more than 50 basis point jump in the 10-year yield since the last Fed meeting. And all that's really just to ask you, when do higher yields actually spook the market rather than fuel it?
Hi. Thanks for having me on. It's a great question. I think that you're right. The path of the Fed pricing has swung back somewhat over the past month or so. And, over the summer in July and August, we did start to see unemployment data start to make the market nervous and think we were going to start pricing 50 basis points in September and then two more 50 basis point cuts. And then since we've had the unemployment data, just passed, it looked as if that, calmed some nerves some, and we've allowed bond yields to float back up again. So we're not quite pricing any more panicky yield cuts from the Fed.
I know that you'll focus a lot on the macro, but I'm just wondering if you have a sense of earnings. The season is just now underway. We heard from the big banks at the end of last week, or at least two. More on tap this week. We'll hear from Bank of America, Citi, Goldman, and Morgan Stanley. How do you think the market is going to kind of digest what we're likely to get in the days and weeks ahead?
Yeah, when it comes to earnings, I feel like we're at a point where, you just want to keep it fairly simple and that good news is good news. It seems as if earnings expectations have come down a fair amount, but companies are doing well, pretty much wherever I look when I listen to conference calls or I hear them on some of the conferences. So I don't think we're in a world that we've seen over the past couple of years where good news has caused people to freak out because it would lead to more interest rate hikes, which the market can't deal with. I think it's a case of at this point that good earnings is good for the stock market.
One of the things we've seen of late is the mega cap tech stocks getting a bid again after kind of sitting out the past 3 months or so. Microsoft and Nvidia, they really did struggle since June. I'm wondering now in this period ahead, because in these past 3 months, you had this really nice spread in markets, which a lot of people championed. And I'm wondering whether or not, we swing back the other direction now, or do you think that this recent period continues?
I know people do like to see an equity market broaden out. I don't, to be honest. I think I'm in the opposite camp, that generally what you want in a good, strong market is for the leaders to do well. And that's companies like Nvidia and Microsoft and, the hyperscalers, as they're called. And, it can broaden out to others is fine. But I think what you don't want to see is the big ones starting to fall and then getting a move into the smaller caps only. I think generally having the big ones do well is very healthy.
David, maybe we can turn our attention to China next. We've seen a lot of stimulus kind of unleashed in various stages, more and more details coming out. Do you think this is going to move the needle in a meaningful way for the global economy beyond China itself?
Oh, beyond China itself? Yes, I would have thought so. I mean, as I look at it, you've seen a very fast and large rally in China equity as the government has clearly changed course, as I see it. The actions do look like they're large, and it seems like there's more coming, and that a little bit like the COVID restrictions, they were on and then they were off. They turned very quickly when they want to, and I think that's what they're signaling. It takes a while for the economic these stimulus measures to have an impact, but the equity market is front running that because I think it believes that it is coming and it is going to be large. And does it help the rest of the global economy? I would have thought so at the margin. Coming out of the 2008, 2009 period, China unleashed a lot of stimulus then, and the rest of the world was very weak, and it was certainly one of the things that helped.
If China does start to improve in terms of turning its economy around, and we just had this Caixin report saying that the stimulus would not only be the $2 trillion that we had talked about before the Chinese Finance Ministry had the briefing on Saturday, but now multiply that times 3, so it would be $6 trillion or some $840 billion worth of ultra long government bonds. Anyway, if China does respond well and the economy gets going, and the U.S. seems to be, going from strength to strength at the moment, could you see a global broadening out of stock appeal, which we haven't really had for a while?
Yeah, I think so. You're right. The Chinese economy is some, 130 trillion yuan, and they've got, say, a 3, 4, 5% hole in GDP that they need to fill if they want to hit their growth targets, because the private sector has been very weak, and they need to short circuit this dynamic. You can cut rates, which they've done, and they've cut reserve requirements, and they're doing things on the mortgage side which are very helpful. But having direct fiscal stimulus is also very powerful. And what they're doing, if it's 130 trillion yuan economy, they want to plug a 3 or 4, 5% hole. That gets you 4, 5, 6, maybe a little larger in trillion yuan of local debt limit increases or further fiscal stimulus that's going to go onto the central bank, onto the central government balance sheet. Does it broaden out? Does it work? I think it does. Yeah, I think it does. And it'll be very interesting to see it move. But they're large numbers. They seem like they're very clear what they're going to do. and they're doing both monetary and fiscal stimulus at the same time. And I think it's powerful. Yeah, I think it's very powerful. I think it will help the rest of the world as well.
So for China, Japan is a major trading partner. We know that. To what extent will Japan specifically be a beneficiary? Can you imagine certain ways that this unfolds?
Yeah, I mean, I for Japan itself, I mean, I think I don't know if there's a particularly large amount of direct carryover from the two of them. I think generally Japan has, due to some demographic differences, has some issues in running its economy at a level that is, like the rest of the Western world. The US has got a structurally higher level of rates than Japan does. And, will a rising tide of the global economy help to lift the neutral rate estimates for Japan? Maybe, yeah, I could see it. Maybe Japan's at 1.5% neutral rate, and maybe they can be near the top of that. But the demographics there may make it so hard for them to do really well for a long period of time.
Well, let's flip it around a little bit and say, if you had your druthers, where would you put your money first? I mean, what's the best looking investment idea at the moment?
Well, we have positions in China. In the Chinese equity market, certainly. We caught the bulk of the rally through some options, and some of the companies are still incredibly cheap. I mean, I don't want to say this is like the 2009 moment coming out of. For the US coming out of the financial crisis, or just a period just after Europe in 2012. But it really might be. I mean, if they're very serious about doing it, the equities are incredibly cheap, and they seem like they are serious, and they're doing things that are very targeted. So Chinese equities, Asian equities look cheap to us.
All right, David, thank you very much for joining us. David Asell, co-CIO at Mount Lucas Asset Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.